All right, let's talk about Indian mutual funds. In just the next few minutes, we're going to cut through all the noise. My goal is simple, to give you a clear, straightforward way to think about this so you can make smarter decisions with your money.
So does looking at the sheer number of mutual funds out there, especially with all the new tax rules, just make your head spin? Yeah, you're definitely not alone. It can feel really overwhelming, almost like it's designed to be confusing. But trust me, it doesn't have to be.
I want you to think of this as your own personal GPS for investing. We're not just going to show you a complicated map and wish you good luck. No, we're going to help you chart a clear path to get you where you want to go, financially speaking.
Okay, let's get right to it and make this super simple. Forget the thousands of fancy fund names for a second. When you boil it all down, there are really only three main roads you can take on your investment journey: equity, debt, and hybrid. That's it. First up, we've got equity funds. Think of these as the accelerator pedal in your car. Their whole purpose is to invest in stocks and go for high growth to really build wealth over the long haul. But just like flooring the accelerator, you can expect a much bumpier ride. It's all about growth, but it comes with higher risk.
And even on this road, you've got different lanes. Large caps are your big, stable blue-chip companies, the reliable foundation of a portfolio. Mid-caps are the up-and-coming players, a nice mix of growth potential and risk. And then you have small caps. These are the high-octane rockets. They have incredible growth potential, but also the most volatility. Oh, and there's also ELSS, which is a special category that lets you save on taxes, which is a nice little bonus.
Okay, road number 2, debt funds. Now, if equity is the accelerator, debt funds are your brakes and your seatbelt. Their job isn't to give you explosive growth. It's all about stability, preserving your money and giving you steady, predictable returns. They do this by lending your money to super safe borrowers like governments and big corporations. These are fantastic for your shorter-term goals. Liquid funds, for example, are perfect for parking cash you might need in a few days or months. Think of it as a savings account that actually pays you a little better. Gilt funds are pretty much the safest bet because they only lend to the government, and corporate bond funds can give you a slightly better return by lending to solid companies. The one thing to keep in mind here is that their returns can move up or down with interest rate changes in the country.
So what's our third and final road? That would be hybrid funds. If you can't decide between the accelerator and the brakes, this is kind of like putting your car on cruise control. It's an all-in-one solution that automatically mixes stocks for growth and bonds for stability, aiming to give you a much smoother ride overall. So what's the bottom line here? It's this: there is no single best road for everyone. It completely, 100% depends on your destination and your timeline. Are you saving for a down payment in 2 years? That points to debt. Are you saving for retirement in 20 years? Well, that screams equity. Your goal dictates the path you take. Okay, so we've got the roads mapped out. Now we need to talk about the new rules of the road, the tax laws. Think of these as new tolls that have been put up, and every single investor needs to know exactly where they are and how much they cost. And listen, this is a really big deal. How your profits from mutual funds are taxed has fundamentally changed, and the biggest impact is on debt funds. Ignoring this is like going on a long road trip without ever checking the price of fuel. It's going to cost you, and it can seriously eat into your final returns. Let's just break this down nice and simple. For equity funds, if you sell within 1 year, you pay a 15% tax on your profit. If you hold for more than a year, the first 1 lakh of profit is tax-free, and you pay 10% on anything above that. But, and this is the big one, look at the change for new debt fund investments. The old tax benefits are gone. Now, it doesn't matter if you hold for a day or for 10 years. Any profit you make is just added to your income and taxed at your personal income tax rate.
Let's just focus on this 15% for a second. What this really means is that if you're trying to time the market, buying and selling equity funds frequently within a year, that tax bill is going to add up fast. It's a pretty clear signal from the government to encourage long-term investing.
But this right here, this is the real game changer. The amazing benefit debt funds used to have was something called indexation. It basically adjusted your buying price for inflation, which seriously lowered your taxable profit. Well, for any new investments, that benefit is completely gone. So what does that mean for you? If you're in the 20% or 30% tax bracket, new debt funds just became a whole lot less tax-friendly.
Okay, we've covered the roads and we've covered the new rules. Now let's put it all together. I'm going to give you a simple, personal checklist you can use to make sure you're making a smart choice every single time.
Think of this as your pre-flight check before you put any money to work. Number 1, match the fund type to your goal's timeline.
It's simple. Long-term goals, equity. Short-term goals, debt. Number 2, get real about your risk tolerance. Don't just say you're an aggressive investor. Ask yourself, honestly, how would I feel, what would I do if my portfolio dropped 20% tomorrow? Number 3, and this is a big one, it's non-negotiable. Always choose a direct plan. And finally, number 4, look for consistency. Don't get fooled by a fund that had one great year. Look at its performance over 3 to 5 years.
Let's just hammer this point home because it is so important. When you invest, you'll see 2 options, regular or direct. By simply choosing direct plan, you are avoiding the commissions that go to a distributor. We're talking about saving 1.5% to 2% in fees every single year. It is probably the easiest, simplest way to get higher returns, and it costs you absolutely nothing to do it. And if you're wondering if that small fee really matters, just look at this. Over 20 years, that tiny difference on a 10 lakh investment can mean literally lakhs and lakhs of rupees more in your account. That's the magic of compounding working for you instead of against you. It's a no-brainer.
So there you have it. You've got the map with the 3 main roads, you know the new rules and the tolls to watch out for, and you have your personal 4-point checklist. You are now equipped to move from being a confused saver to a confident investor. The only question left is, where will you begin?